Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, podcast listeners, to the Absolute Return Podcast. On today's show, we welcome special guests, Alliance Entertainment's Chairman Bruce Ogilvie and CEO Jeff Walker. Alliance Entertainment is a distributor and wholesaler of the world's largest in-stock selection of music, movies, video games, electronics, arcades, and collectibles. On the show, Bruce and Jeff discuss insights, challenges, and opportunities in the distribution business, the company's roll-up strategy, how Alliance competes and grows in an era of streaming, their thoughts on the current macro environment, and more. A point of disclosure, the Accelerate Arbitrage Fund ETF does hold shares and warrants of Adara Acquisition, the SPAC in which Alliance Entertainment is merging with. With that said, please enjoy our show with Alliance Entertainment's Chairman Bruce Ogilvie and CEO Jeff Walker. Welcoming Bruce and Jeff to the show today, all the way from Washington and Miami. How are you guys doing today?
Good.
All right, awesome. Thanks for coming on the show. Now, I did want to touch on your background before we get into the business of Alliance Entertainment. Specifically, you both have been in the distribution business for multiple decades. Could you give us a quick overview of your background in the industry? And we'll start with you, Bruce.
Well, I started selling music at the swap meets in 1978, and from the swap meets, I gravitated to becoming my own distributor, wanting to compete with my current supplier, and that's when I started a small distribution company called Abbey Road in 1980, and then I grew that business to like $95 million a year in revenue, had a liquidity event in 1994, entered into a 5-year covenant with the buyer, got involved with a couple of startups, got warehouse bankruptcy. When my covenant not to compete ran out, then I was going to rekindle my relationship with Jeff and Horowitz. Jeff and David had started a company called CD Listening Bar, which I knew from 1991. They were one of our retail customers. And then I joined a CD Listening Bar in 2001 with Jeff and David. David left us after a few years. And then Jeff and I just kind of went on a tear, from taking it from $18 million a year in revenue to $1.4 billion in revenue today.
And Jeff, where did you come from? Where was your background? And if you don't mind, when you're not speaking, if you could put it on mute, that'd be great.
Yeah, hello. My background is I was at UC Irvine, graduated with an economics degree there. And my friend David and I decided to write a business plan while we were at UC Irvine for a music store. And after we graduated, we opened a store called CD Listening Bar that was in Southern California in Orange County. 18 months later, we were able to open a second store. And at that time, we were buying from Bruce at Abbey Road and got to know him pretty well. And as it went along, Bruce, as he said, sold the business. And when he sold it, we kind of said, well, maybe we should get into wholesaling business because our friend's out of it now. So we started selling to other music stores from the back room of our Irvine retail location and continued to grow the business from there. As Bruce said, he joined us in 2001. And over the last 20 years now, Bruce and I have really been focused together to build the business to where we are today.
Now, obviously, this business has changed dramatically since your humble beginnings and early successes in the 80s and 90s. Now, how have you adapted to that as, the music business and video games and the streaming has come into play? How has the business evolved, not only evolved, but also thrived over the past, 35 years?
I'll take that. So definitely a whole learning process as we went from traditionally a pure physical packaged media provider of music. And certainly we had a front row seat on the transition from physical into digital, even starting in the early days of Napster. I mean, I thought that was a pretty cool product there for what it did there. Of course, it didn't do much for the artists, the record companies for the rights at the time there. And I even applied for a job at Napster to try and get in there in the early stages there. I never got a call back, but I tried. It's a good idea there. I felt I could really help them, put out all the fires they had started with, the digital distribution, ripping all the music off and all that there. And if I could educate them and make them smarter, they could have been successful. And maybe they would be way better. They could have been bigger than Apple is today if they listened, we had a little time with me. Because I understood the record companies and how they thought at the time there. I did so much business with them over the years there. But through all that, though, Jeff and I really learned early on there, and we just saying, if we don't diversify, we're going to die. And so with all our, energy, devoted to physical media being music, and also we were very heavy into video, the handwriting was on the wall, where streaming was going to go. First it started with downloads, and the download went to streaming there. And, you went from, pay for what you want, $1.30 a song, to $10 a month for all you can eat buffet type deal there. You could just see what's going on. But the one thing that we saw through all this was happening is music is something that, you got to provide promotion, and streaming and all you can eat is really no different than the days when music first started. They put out the 45. The 45 was a promotional tool. It was a marketing tool. Problem with 45s is that you have to take back the returns. They always lost money on it. That was a very heavy promotional expense there, and they cut it out really fast. Streaming is so economical and efficient for the record companies that consumers have access to more music than they've ever had in their entire life at the cheapest prices ever there. And that's a great way to get people exposed. And that gets them interested in wanting to go to the concert. If they want to go to the concert, they will engage with the artist. They'll have that connection with the artist. They want to brag to their friends they went to the concert. They want to take pictures at the concert. It's everything I'm doing that, all that there. And they got to buy physical media. And the LP is really just a natural choice for that ownership. You're now making a commitment to that artist there. And it's in long term, we see it's really going to come down to streaming and LPs is kind of key. Where's that on the music side of things there, of course. We're also heavy in video. We're also heavy in games. And I'll just stop there if you want to go into that separately. But I want to keep the whole music side there from that standpoint there.
This podcast is brought to you by Accelerate, one of Canada's leading alternative investment solution providers. Do you want to hedge your investment portfolio and protect your nest egg from significant drawdowns? Look no further than the Accelerate Absolute Return Hedge Fund, a long-short equity ETF that trades under the ticker symbol HEDGE, HDGE, on the TSX. HEDGE, your uncorrelated portfolio diversifier. Find out more at accelerateshares.com.
Yeah, and actually, if you don't mind, would you be able to go into the different segments and give us a little bit better idea of where you sit in between the consumer and retailers?
Well, we're primarily a distributor. That's who it is. We buy from the large record companies, movie studios, and game publishers, and we turn around and we sell that to people who own brick and mortar stores. It could be a chain retailer, an online retailer, an independent retailer, as well as we'll do export for areas we're allowed to market to and sell to. We also have a very small part of our business is we do our own retailing with our retail brands that we own and control. It's going to be catalogs, websites, and we sell on Amazon Marketplace, eBay Marketplace, Walmart Marketplace, Target Plus, anywhere and everywhere we can. And we mail out close to 500,000 catalogs a month. We're pushing music and video, and that's for people who just like to thumb through a catalog and create an impulse buy there. But that's how our whole business operates. It's distribution, retail, very strong partner with a Walmart and a lot of chain retailers who really rely on us for either a large percentage of their music or all their music, as well as movies to distribute in games.
Now, in terms of segmenting your business for the sales that you generate, how do those segments fall out of that in terms of percent of revenue from music, movies, and games?
Yeah, I was just scrambling to get my notes out there. Give me a second here.
Could be just rough numbers, estimates.
Yeah, well, video games, the very top number there is over 40% of our total revenue there.
Okay.
And starting on the music side there, that's right around 30%. 30% range, Jeff, 35% range of LP and CD. Yeah. And then behind, were you going to say something, Jeff?
We have video at another 25% or so.
Correct. And then we have collectibles, Funko toys and things like that, which we distribute all that because those are items that draft off of tentpole new releases, whether it's a new movie or new TV series or a hot fan, anything that will, make that consumer want to own something that's not, you can't download, you have to physically own it, show it off to your friends. We distribute those products also.
Now, as I understand, one key component of your growth strategy is this consolidation or roll-ups of competitors that you're doing. Could you describe that and how you expect it to generate returns for shareholders?
Yeah. Jeff, you want to take that?
Okay. Yeah, I'll run with that one. I remember when we did our first acquisition in 2003, and it was kind of learn by fire. We went through it, we did it, and we've done over a dozen significant acquisitions since that first one in 2003. And we're looking for different components. One strategy that works well for us is somebody in one of the categories that we're already in, and it's a pure consolidation, saves a lot of warehousing costs, IT costs, and duplication there. Those are always good acquisitions for us. We've also stepped out into acquisitions that got us into new categories. So we were able to acquire Mecca Electronics in 2018 that got us into the gaming business. And, when you move into a new category like that, we were able to get ourselves open accounts with Microsoft, Sony, and Nintendo. We could not get those just calling them direct and opening new distributors. So that's a strategy that has worked for us as well. Today, going forward, we're definitely, we've been able to do all these acquisitions just from our asset-based financing as well as reinvesting our profits in the business. So we have not had to bring in any outside capital to do those. And that's part of the reason why we're excited about the de-SPAC process going into becoming a public company, is it gives us a whole other opportunity to have some outside capital to support us in acquisitions going forward.
Yeah, that makes a lot of sense in pursuing this going public transaction, the ability to utilize shares in addition to cash to just supercharge this roll-up strategy. Now, where are you currently seeing the best growth opportunities for growth for this roll-up strategy?
Well, there's definitely a lot. Being a diversified business, it's a lot more interesting opportunities because we are diversified. So we look at companies that have products that are similar to ours, whether it could be toys or collectibles or still gaming and those type of products, bringing those in. We've also looked at companies that have products that aren't ones that we're currently stocking, but they're selling into a major retailer like a Walmart or Best Buy or a Target that we do significant business with already. So this gives us a whole nother channel of business with these large retailers. So that can be a good opportunity as well. So it's a pretty wide range right now. There's definitely good opportunities out there. One last thing I want to say about it is typically in the past, because Bruce and I did not want to have a small partner, an 8 or 10% partner, most of the acquisitions we did were entrepreneurs that were retiring or exiting the business. By being on the public side, we can have a growing business with a strong entrepreneur decide they want to team up with us and, maybe take some cash off the table, maybe not, but also, become a shareholder in the combined alliance business and continue to run something that is growing and has, a long runway ahead of us. So we're excited about that part. Because that really does open us up to some new opportunities, of some growth companies that we could add to our mix.
It certainly, Alliance Entertainment is a different opportunity than what we've seen in SPACs lately. Specifically, sentiment on, music, movie distribution isn't great because people look and they're like, oh, well, streaming's becoming more and more popular. What would be the future for this company? Now, where do you see the risks? What keeps you up at night? And how would you address skepticism from investors with respect to the growth potential?
Yeah, so I'll take that one. I think before getting to the risks, one of the things we're really trying to develop is Alliance Entertainment as the place to go for all your entertainment products. And it means, in packaged media, it could be an arcade game, it could be a lava lamp, it could be a toy or collectible, anything that's within the trend and the franchises around all of this media, whether it's music, movies, games, and so forth. That is a big, big space when you put together the entertainment space of gaming, video, music, and all of that together. And so if you look at us as a company that's trying to become the go-to place in the entertainment side, I kind of then look at what Ingram Micro is on the computer side and what Grainger is in their space and so forth there. That's what we're trying to put together, where every one of the content providers, whether it's media content or collectible content or toys or whatever, want to be working at some point with Alliance, as well as we're working with all the retailers in some department or fashion there. So that's where we're trying to develop where we're going. As far as the risk, we definitely in some categories, for instance, CDs that have declined significantly from where they were before, but now our business is about 10% on CD. And, there's another component here where it is a risk to be in the media category, although in gaming and DVD, we're still less than 10% market share of all the games and DVDs that are sold. And there's a risk of shrinking, but there's also a thought that at some point in time, the music labels, the studios, the publishers are all going to really try to move away from physical because of their digital strength, and they're going to license off their physical rights to somebody like ourselves to be the ones to manufacture it, sell it, and distribute it, and they get out of it in the sense that then they just get a royalty similar when they do a toy or a collectible or something like that. It will just be another component of the merchandise. So there are risks in there, but there's also upside as those risks move around.
Yeah, it's funny because as tech-forward millennials, everyone thinks, streaming is here to stay. No one does physical DVDs anymore, but you'd be surprised. I think Netflix still runs that, DVD in the mail, and I believe they have millions of subscribers. So there's people out there who still like the physical CDs, physical DVDs, and I don't think that's necessarily going away tomorrow.
Well, there's if you live in the mountains, the bandwidth is really a problem. You have to rely on Q satellite, to get there, and that's kind of down with the latencies were pretty bad, so that's no good there for streaming purposes. They're playing or gaming or things like that, and not everybody has cellular service where they're at, so on the road. So look, we're not saying it's going to be the glory days of what it was, but it's packaged media, physical media. It's just not going to go away. There's just still people want to own stuff and have stuff and prioritize stuff there. When you stream, you're just renting. You're not really, you're not committed. You can drop it tomorrow and it's done with. And then the other thing is you lose your collection once you turn it off if you stop paying the $10 a month renting. So that's the story. If you're a collector, and there are collectors out there and all that. But the book industry was doomed for years when the Kindle came out there. And it actually finally hit bottom and it's been trending up. And it just comes down that people want to have that book put on their coffee table to brag to their friends. This is what I read, how smart I am. This is what I'm into. So it's all about me. I'm show off me.
Yeah, that's a good point with respect to the technological issues of, say, those living in rural places.
It's solved over time. There's no doubt about it. They'll figure out how to do it better. There'll be plenty of satellites up there with tons of bandwidth to deal with all that there. They have that now. It's kind of expensive. You got to buy that. Was it $1,500 to buy that item to receive it? Service.
I'm at my condo last night. I can't even. My Netflix is not working on my Wi-Fi. I'm like, what is that? It's not a perfect science on the Wi-Fi for sure.
But it's very convenient. Can't beat it. But if you're a serious collector, or you're really into artists, or you want to collect things, you need a physical media to get there.
That makes a lot of sense. Now, with respect to this recently announced SPAC merger with Adara Acquisition, I was wondering, what has been the investor feedback thus far?
Well, we've had about 75 calls with portfolio managers that started when we tried to raise a PIPE. Pipe market's pretty dead. We learned that fast there. So we stopped that. And so then it led to some other calls. I think at first everybody is a little, wait a minute, that's buggy whip industry, melting ice cube,
Yep.
But when they heard what we did and what we're doing and how our sales have grown and what we've accomplished and how we're continuing to invest in the areas in our business to make us more efficient, we can pretty much distribute anything that fits in our size, our package size. So we'll have a great, it comes down to fulfillment. Who can get the orders out and get the job done there? And that's what we do really, really well. That's our secret weapon, having our fulfillment centers that we have in place there. Just like Amazon, look at how Amazon does it. So we have to keep investing in that, not crazy investment, just minimal investment to keep the system going and all that, but we're willing to do that there. And that's been working really well for us, and there's no complaints there from our customers, and we'll continue to grow. But if we have to pivot into something different to distribute there, because there's always people knocking on our doors wanting us to distribute something there. We just want to make sure it fits into our ecosystem. When Amazon has 3 different size warehouses, small, medium, and large. You would put us in the small category type of products. We can't run Vizio TVs or refrigerators through our warehouse. It's not designed for that, laid out that way. But there's a lot of electronics. There's a lot of other things that we can distribute that would work really well in our environment there. As what we kind of show people is that we're nimble. We'll diversify. We'll adjust. We'll pivot. We don't want to go out of business. We have to diversify, and we'll do that. And we've been very good at that with all the companies that we've acquired. We've been able to diversify from purely a music company into music and video movies. And now we've gone very heavy into gaming category there, retro arcades, all these collectible items. We're a very large distributor for Funko right now, probably one of their largest distributors they have in the United States right now. And so because we were able to pivot into that, and we had the customer base, and we had all the expertise in selling on the marketplaces, whether it be an FBA with Amazon or whatever it takes to make a sale. That's how do we reach those customers? Who's got a good website? Can we get all these products listed on their websites or expand their selection? It's a great deal for people who buy from us and have a website. They really have no risk in the inventory. All they got to do is take a feed from us and just get it in front of eyeballs, their consumers, and then just sit back and let the register ring, and we do all. We have to ship the product, we order the product, we warehouse the product, deal with the effectives on the product and all that stuff. And that's our job there. So
I think also to the question of what the investors were saying to us, I think most of them were shocked. You guys actually are making good money. That was the number one comment. We see so many of the companies coming through the SPAC process that are not that much different than traditional IPOs in the day of some type of startup business that is burning cash and needs cash to continue to try to make it to the profit land on the other side. And I think that's a big thing that we're getting. And you're hearing that a little bit in the industry conversation about where people are moving towards. They're moving more towards established businesses that, produce profits and have steady income and so forth there. And we fit that model here going forward right now. And the last thing I want to say about that is, we're not in the aspect here of going public and having to raise a lot of capital to keep our business going.
Right.
We're profitable. We're generating profits on a monthly basis. So our reason for going public is solely to give us some expansion capital to really try to grow the business through some acquisitions. So it's a different conversation than, somebody that's burning cash and the investors are going, well, how long are you going to survive until you need your next infusion? And we're just not in that conversation.
Yeah, certainly the free cash flow and EBITDA is something that we haven't seen often in the SPAC market. In addition, I think the valuation on the SPAC merger is roughly 6 to 7 times EBITDA, which I'm sure catches some investors' attention. And then the other discussion topic being that of so-called melting ice cube for mature or sunset industries. And I have seen in other industries where as long as you can make acquisitions at multiples that are accretive and you have that free cash flow and you can just keep that machine going. I have seen roll-up strategies work very well in other sunset industries. Not saying it's going to be successful every time or that it's easy, but it seems like there is a blueprint that you can look at there.
Absolutely.
And I think to add to that, one of the things we've been talking about with investors is, well, it's not our first time trying to do an acquisition. We've seen a lot of business owners that, we've acquired in the past that have been in business 30 years and never done an acquisition. And we've been doing significant ones over the last 20 years. And so when we in the conversation, we want to have access to capital to expand our acquisition strategy. It's not like, hey, we're going to hope to do an acquisition and hopefully get it right. It's not only Bruce and I we're heavily involved in the negotiations and stuff, but we have a significant team behind us now, from the time we do the acquisition to integrate it and get it all working within our business. So that as a company, we're experienced in acquisitions and that roll-up strategy that you just mentioned.
And now, a word from our sponsor, Accelerate, one of Canada's most innovative and fastest-growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate Arbitrage Fund, symbol ARB on the TSX, is the world's first SPAC-focused ETF with a diversified portfolio of SPAC and merger arbitrage opportunities in an easy-to-use, low-cost ETF. The Accelerate Arbitrage Fund ETF trades under the symbol ARB on the Toronto Stock Exchange. Find out more at accelerateshares.com.
And so switching gears a bit here, many investors are interested in turnaround situations. And Bruce, you've been involved in at least one of these with Warehouse Records, which I believe that had sold to Cerberus Capital a number of years ago. In your mind, what makes a successful turnaround investment?
Oh, so what do we look for? I mean, I don't think
Well, we're not a turnaround.
Yeah.
Oh, no, this is just backing up into in your previous experience. Now, this itself isn't, but for some of our listeners who are more generalists that like looking at turnaround situations in other areas.
Or perhaps, do you guys look for acquisitions that you can improve and turn those businesses around?
Yeah, I was going to say our favorite acquisition is a company that let's say their profit is break even or you're making very little money, but they have the same type of overhead that we have, giant overhead there, and we can take that. Basically, we don't have to pay a lot for it because as a standalone, it's only worth what it's generating as EBITDA at best there. Let's say only made $100,000. It's a $10 million a year business there, and the seller says, "Well, I want a 3x multiple." Okay, that's $300,000, but he has $1 million worth of redundant overhead. We would keep all those synergies, and we did learn that through private equity acquiring things that you don't reward the seller for the synergies. The synergies go to the buyer there, and so. When we have a seller that's got their hand out for, look at all the synergy you're saving, well, there's no guarantee we're going to get that, and that's That's our risk. We have to take that. But you're getting your 3x multiple. So that generally makes the conversation a lot more palatable. That's our favorite type of acquisition.
Yeah. Well, one of them, to expand on that, one of the things that we see that happens in an example like Chris just said is that somebody might have significant amounts of capital, working capital tied up in the business. So they might not be making money like that, but they might have, their assets exceeding their liabilities of $10 million. And they're like, well, I got $10 million just a book value tied up in here. And we've had one in the past where they just wanted to get their book value out of the, their cash that's tied up in that business out of the business. And, you could see that is part of, kind of their profits over all the years is stuck in that business. And then if we can come along and get them out of that, so now you're really buying something almost at a zero goodwill. You were able to cash them out. You just bought it for book value. But if they continue running and operating the business needs, that capital in there to continue. And maybe they weren't running the capital as efficient as they possibly could have. So we try to figure out how we turn inventory quicker, and we reduce that, that $10 million of working capital they had in there down to $2 or $3 million of working capital. And you end up with a good acquisition that way.
One thing to add to that, just for the listeners' benefit there about the turnaround situation, is for a company we want to buy is how much working capital does the business require to operate there. And so the one thing we kind of learned to do, our rule is we do like a 12-month rolling 12-month average of what the net working capital requirement is. Just taking really something very basic is AR plus inventory less AP, assuming bank debt would be out of the question if we're not assuming any bank debt there. And say, okay, what is that? How does that look per month? What's the rolling 12 months? And then we call that peg. We set the peg, and then we say, okay, the purchase price is now X, the peg is Y, and if the peg goes, if the net closing value using the same calculation there is higher or lower, that would adjust the agreed upon purchase price there. Protects the buyer, protects the seller. That keeps the seller from trying to, slow pay all the vendors, and the AP starts running up there. Now the net book value gets smaller because they take all the cash. So at the time of close, then that forces the seller to put cash back in or buyer to pay more money because the net book value is greater. So we've had cases where the net book value was less than the pay. We've had cases where the net book value was higher than the pay, and we had to pay a higher purchase price there. But at the end of the day, we're getting the assets that have the proper reserves for inventory, for AR, so that we're not buying, that we're just, what can those assets turn into cash in the ordinary course of business there?
Yeah, that's really good advice for those looking to make acquisitions, to keep close tabs on the working capital and make sure the seller doesn't play any games with respect to not investing or kind of draining the working capital prior to closing the deal. So that's really appreciated. Now, prior to letting you guys go, Bruce and Jeff, I was wondering, what time do you wake up every day, and what's your favorite productivity hack? We can start with you, Jeff.
So it's funny because this answer is going to be the opposite to the two of us.
Opposites attract.
I'm typically up till 2 to 3, and I'm probably up at 8 in the morning, and so that's on my time frame there.
I'm the early riser of the two. It's kind of worked out well that way because a lot of our people we deal with are on the East Coast. So, when I go to bed at, around 10, and I try to head to bed, one last quick look at the emails. I want to make sure there's nothing sitting in there that I have to deal with before I go to bed. And then when I get up, then I've probably got 100 emails that come in, from the night there. Now, I don't read 100 emails. There's just a lot of reports and things like that come in there. And I can quickly rifle through them and identify, okay, what are these things I need to take care of in the next 30 minutes just to keep I like to get off the clock so the other person, if they're waiting for an answer from me, I want to make sure I respond quickly and get it to them and then move on to the next thing the rest of the day and try and keep up with the pace. So that's...
One quick funny story back when we acquired Alliance in 2013, George was the CFO.
Right.
We were both in California at the time, but we were diligently working on stuff after we did the acquisition. I'd be emailing it out until 2:30 in the morning, and then Bruce would, wake up at 5 and he's starting emails at 5. And he's like, oh my God, you guys have got me 22 hours a day or something. It was pretty crazy.
That sounds like a good tag team there.
Funny story. Yeah, funny story.
All right, thanks. Well, it was great having you on the show. It was good to get some insights into Alliance Entertainment, where you think it's going, the growth opportunities, and some good insights for investors here. So wishing you the best of luck with your going public transaction, merging with SPAC acquisition, and we'll be monitoring the story closely. So thank you and wish you the best of luck.
Thank you, guys.
Thank you very much.
All right. Bye, Jeff. Bye, Bruce. Take care.
Bye, guys. Thank you. See you later. Bye-bye.
Bye.
Thank you very much for that.
You're welcome. Thank you.
Thank you.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.